Hello, welcome back to the show. So in today's video, I'll be talking about my greatest investment mistakes so far. So in today's video, I'll be covering a few things. We'll be covering my investment mistakes, Bill Ackman buying Amazon, as well as some questions that you guys have left me in the comment section below. So the first stock that I bought at the start of my investing journey was Tesla. So this stock, I bought it at around 2021 or so. At that point, I entered at around $300 a share, $900 pre-split. I rolled it up and then the stock crashed by more than 50% or so. So why did I buy Tesla? I bought Tesla because I was chasing the hype. I didn't know anything. And I remember telling my parents in 2021 or 2022 or so that the company is growing at 40% year on year. And I blindly followed a Singaporean YouTuber as well at that point. And then I did fine at the start, but after a few months, the stock market peaked and then the crash started from there. So I bought Tesla at around $900 a share pre-split and I sold it at around $850 a share. I rolled it entirely down towards $120 post-split, which is around $300 pre-split, and I decided to cut my losses and get out at around $850 pre-split. It was the wrong decision to sell as well. Similar to my decision to enter into the stock, I had no TCs, I had no reason, and then I just sold the stock simply because I wanted to cut my losses and get out. So lesson over here, don't chase meme stocks, don't buy because someone else is telling you to. Tesla was a company that was hyped up by retail and Elon was a great salesman. He sold a story and although the company was overly expensive, I bought into it. So you need to buy with a thesis and sell with a reason. Clearly I didn't have any of those and that's why I lost money in Tesla over here. Next mistake is panic selling. So there was once where I experienced the entire cycle of going into hype, euphoria, crash, and then capitulating and selling at the bottom. So I sold too late and I lied to myself. This is confirmation bias over here. So confirmation bias is when you lie to yourself and you basically block out all the bad theses for a stock. So for example, like Tesla back in the day, all the Tesla bull investors that bought at a peak were just lying to themselves, saying that the stock will continually grow 40% each year, which is clearly unsustainable for any business. And that was what led to Tesla stock dropping all the way until $120 in 2022 because the stock was simply too expensive. So when you're investing in a stock, make sure you don't subject yourself to confirmation bias. It's one of the riskiest problems out there and it's one of the worst biases that you can have because you could be holding on to something that is fundamentally breaking and not realizing it because you're trying to block out all the bad cases for the stock and lying to yourself. So this is Warren Buffett words when it comes to holding a stock and holding it through a 50% drop if you have conviction behind it.
Into them. I mean, the main thing to do, and you're not going to pick the bottom and nobody else can pick it for you or anything of the sort. You've got to be prepared to, when you buy a stock, to have it down 50% or more and be comfortable with it as long as you're comfortable with the holding. And I pointed out, I think a year, maybe 2 years ago in the annual report, just the one before this most recent one, I pointed out that there have been 3 times in Berkshire's history when the price of Berkshire stock went down 50%. 3 different times. Now, if you owed it on borrowed money, you could have been cleaned out. There wasn't anything wrong with Berkshire when those 3 times occurred. But if you're going to look at the price of the stock and think that you have to act because it's doing this or that, or somebody else tells you, well, how can you stay with that when something else is going up or anything? You've got to be in the right psychological position. And frankly, some people are not really careful. Some people are more subject to fear than others. It's like the virus. It strikes some people with much greater ferocity than others. And fear is something I really never felt financially, but I don't think Charlie's felt it either. But some people can handle it psychologically. If you can't handle it psychologically, then you really shouldn't own stocks because you're going to buy and sell them at the wrong time. And you should not count on somebody else telling you this. You should do something you understand yourself. If you don't understand it yourself, you're going to be affected by the next person you talk to. And so you should be in a position to hold. And I don't know whether today is a great day to buy stocks. I know it will work out over 20 or 30 years. I don't know whether it'll work out over 2 years at all. I have no idea whether you'll be ahead or behind on a stock you buy on Monday morning.
So when it comes to owning a stock, you should form a thesis before buying. Sell the stock only when the thesis is broken. If there's no thesis before buying a stock and you don't know what you own, and then that is when you will start panicking when it comes to owning a stock. So be prepared for downturns and hold enough cash to weather the storm. So for Warren Buffett, currently he's holding around 27% cash. I know a lot of people will say holding cash is like holding trash because cash will lose to inflation. But over time, if holding more cash allows you to sleep better at night and basically buy when the stock market drops, then holding cash isn't too bad as well. So when it comes to owning a stock, make sure you form a thesis. Don't buy a stock simply because someone else is telling you to. Third mistake that I made was trying to predict the market. So back then when I started out investing, these were two of the common phrases that I will always use. So the first one is, oh, the market already went up, it's going to crash. Or the second one is, the markets are crashing, it will crash more. So these were the things that I was telling myself and others around me constantly. But the truth is this, people love predictions because predictions create certainty even if the certainty is wrong. And it's human psychology to want to have certainty and to crave for certainty. But the problem is this, no one can truly predict the markets. Over the long run, stocks will go up, of course, over the next 10, 20 years or so. But within 1, 2 or 3 years, it's impossible for you to predict the markets. And this is what Warren Buffett has said about predicting the markets in general.
Can you expand on where the market's going from here?
Well, I could expand, but I couldn't answer. Charlie and I haven't the faintest idea where the stock market is going to go next week, next month, or next year. We never talk about it. It never comes up. Our directors will tell you that they've never been to a directors meeting where the subject of the direction of the stock market is. We are not in that business. We don't know how to be in that business. Obviously, if we could guess successfully a high percentage of the time where the stock market was going to go, we would do nothing but play the S&P futures market. There wouldn't be any reason to look at businesses and stocks. So it's just not our game. We don't think, what we see when we look at the stock market is we see thousands and thousands and thousands of companies priced every day, and we ignore 99.9% of what we see, although we run our eyes over them. And then every now and then we see something that looks like it's attractively priced to us as a business. Forget about the word stock. So when we buy a stock, we would be happy with that stock if they told us the market was going to close for a couple of years. We look to the business. It's exactly the same way as if you were going to buy a farm a few miles here outside of Omaha. You would not get a price on it every day, and you wouldn't ask, whether the yield was a little above expectation this year or down a little bit. You'd look at what the farm was going to produce over time. You'd look at the expected yields, you'd look at expected prices, the cost, taxes, the cost of fertilizer, and you would evaluate the intelligence of your purchase based on what the farm produced relative to your purchase price. Quotes would have nothing to do with it. That's exactly the way we look at stocks. We look at them as businesses. We make judgments about what the futures of those businesses will be, and if we're right about that in those judgments, the stocks will take care of themselves.
So this is what Warren Buffett has said. He's basically saying that it is impossible for you to predict the markets over the short term. Over the long term, stocks will go up, but it is best for you to stop predicting the markets and basically just buy fundamentally good businesses that will have good economic long-term projections so that in the long run, you'll be able to compound your returns and the stocks will take care of themselves. Next portion over here, I'll be talking about Bill Ackman buying Amazon. So if you didn't know, Bill Ackman's Pershing Square, they basically bought Amazon and they exited Canadian Pacific over here, which is a railway company. So this is what the report over here says. It says, Pershing Square has also added stakes in car rental company Hertz and transport company Uber. At the same time, they sold out of Canadian Pacific. Ackman said, noting that it is a position the firm sold with regret. Ackman in 2022 built a stake in Canadian Pacific, returning to one of his most profitable investments as rail firms eye a boost from drive to cut carbon emissions and as manufacturing is brought back to the US and Mexico from abroad. But in order to buy the Amazon stake, Ackman needed to make adjustments and came to liquidate Canadian Pacific. He stressed that he thinks extremely highly of Canadian Pacific team and has strong belief in the long-term future of the business itself. So for Amazon over here, it's a high quality business. It is incredibly consumer centric and can easily raise prices in the future. So if you're to look at the Amazon Prime subscription, the Amazon Prime subscription has a lot of different portions under the entire Amazon Prime subscription. So they can easily just double the prices and it will still be affordable and reasonable for the consumers. And the next thing going for Amazon as well is Amazon is trying to shift from growth to profitability. So that is what Andy Jassy has been stressing all these quarters. They're trying to return more capital to shareholder and trying to shift and increase margins over time. That is what they're trying to do. And then the last thing that is going for them is that they are the leaders of cloud. So for Amazon stock, The worst case is likely over already. Amazon has around 50% of its third-party sellers from China, and with tariffs now at around 10%, the impacts will be limited. So this is what Ackman team said about the tariff impact that was surfacing on Amazon. He said, "We felt that the company would be able to work through any slowdown in cloud computing division, AWS, and we did not judge that the tariffs would have a material impact on the earnings in the retail business." So over the short run, the tariffs could have some impact on Amazon, but if you're to judge this from a long-term basis, this will likely be a small blip in Amazon's earnings, if anything. And now that Trump has reduced the tariffs on China to 10%, I see this impact as highly unlikely in terms of Amazon's earnings as well. So cloud demand is still strong. Sundar Pichai mentioned previously that cloud demand is still strong and they are supply constrained. Azure just re-accelerated in growth despite all the tariffs, and Amazon will likely still grow in strength and improve margins as well. So if you're to look at AWS margins over time, it is incredibly remarkable. They have expanded their margins so much that AWS now makes up around 68% of their total net income, and Amazon as well. So this is Amazon's story. It's a simple thesis. It's a thesis of margin expansion. So they have the ad business, which is improving margins. They have the subscription business, which is improving margins as well. And the CapEx can be used to improve efficiency, especially with the robots that they have in the sorting division, the logistic portion, as well as the returns that they're having in cloud as well. So cloud is growing rapidly and margins are expanding rapidly as well. So this shows that the CapEx now is yielding returns. I wouldn't be too concerned about the CapEx spend right now because the ROIC is increasing for Amazon as well. So this is Amazon's R&D over here. So if you're to look at Amazon's R&D, it's around $22 billion. So this line over here, technology and infrastructure, is around $22 billion. And even some portions of the fulfillment network is R&D as well. If you're to compare this with Google over here, Google's on the right, Google's R&D spend this year is only $13 billion in Q1. So if Amazon basically reduced their R&D spend to levels that Google is spending, Amazon could easily double their earnings. So what Amazon has been doing all these years is they've been suppressing their earnings to basically improve the growth over the next few years. And that is what you're seeing in these numbers as well. They're increasing their R&D costs, they're actively pushing it up so that there's a better experience for all their consumers so that the company can continue growing and growing and growing instead of focusing too much on profitability, although the profitability metrics are already appearing. So I view this as extremely positive for Amazon. Once they slowly start shifting to profitability, which is what they're doing now, you will likely see alpha above the market. Last portion over here, I'll be talking about some questions that you guys have left me in the comment section. So the first one over here, it says, "Hello, what do you think about BG Foods?" So I've looked into BG Foods fundamentals. The company is a micro cap. It's around $300 million market cap. And the company has negative profit. So for me, typically when I'm owning a business, I want a business to be at least profitable. And for BG over here, I'm not too sure why the net profit is down. And so I don't think this stock is one that I'll be looking at. It's a company, it's a small cap, and I typically avoid those because they're unpredictable in nature. Next one, what Singapore REITs do you hold and how do you purchase them? So for the REITs that I hold in Singapore, I mainly hold your CapitaLand Integrated Commercial Trust, that's CICT, as well as Fraser Centrepoint Trust. I own some SIA as well, which is the Singapore Airlines. The airlines were very cheap last year, and that was when I started buying into the position. But currently now I'm thinking of exiting those positions once they reach fair value or so. I don't view the REITs as high quality. The dividend cash piles, but for me, I'm still young. I want more growth ahead instead of focusing on 5-6% returns from the dividends itself. As for how to purchase them, you can purchase them on IBKR if you're from abroad, or you can just simply buy it on SGX if you're living in Singapore as well. Last comment over here, it says, what's your opinion on Kraft Heinz? Similar style to General Mills, 52-week low, around 6% dividend, Warren Buffett is holding. So for Kraft Heinz, I've actually looked into this company. I was researching it while searching up General Mills as well. General Mills is a company that is experiencing volume decline. The only reason the EPS was up this quarter, which is Q1 of this year, was because they had a divestiture and they added back into their earnings. So similar story for Kraft Heinz. Kraft Heinz is also experiencing volume decline. And if you were to look at the suite of products for Kraft Heinz, the only one that stands out is their tomato sauce. As for General Mills, I think the brands are a lot stronger over there. They have Churros, they have Nature Valley, they have some portions of Haagen-Dazs as well outside of the US. So for Kraft Heinz over here, although the dividend is extremely appealing, but the problem with the business is I'm not too sure how the volume will hold up in the next few years because the only thing that they sell is their tomatoes. The only thing that I use from them is their tomato sauce. So for me, I don't think Kraft Heinz is one that I'll be looking at. I'm actively looking into Pepsi as well, but same story, the volume is declining and I'm not too sure what their pricing power is. And the only way that they've been growing all these years is through acquisitions, which is what I don't like as well. But if Pepsi starts going down to a reasonable valuation, around a 15-16 times earnings, when the valuation is compelling, that is when I'll be looking to add as sort of like a deep value short-term play. Thank you so much for watching. I hope you guys have found this one useful, and invest safe.